July 25th. Just today, the largest commercial bank in China completely stopped its paper gold trading for millions of regular customers. Not in 9 weeks, not in 9 months, right now. And this bank wasn't the only one. Several other major Chinese banks did exactly the same thing. The official explanation for this decision is that they're protecting ordinary people from gold price fluctuations. I don't buy that. I think today's the day the world realizes that the gold price you see on your phone screen isn't real at all. Let me tell you about something else that hardly anyone has heard about. In 1980, two billionaire American brothers named Hunt decided to buy up almost all the tradable silver in the world. The price of silver went from $6 to over $50 per ounce. Within a few months, everyone thought these two brothers were geniuses. But there was a problem with all this. Just like today's gold market, the silver market was full of paper contracts that weren't backed by any real metal. When the Hunt brothers tried to take delivery of the actual metal, the exchange suddenly changed the rules of the game. They multiplied the margin requirements, and the price crashed from $50 to less than $11 in just a few days. That was exactly the day the world realized the paper market and the physical metal market are two completely different worlds. Now the same thing is happening again. The difference is, this time the main player isn't a private company. It's a country with a population of over 2 billion people. Let me explain to you exactly what paper gold is, because this point is the key to the whole story. When you buy gold these days, usually no physical metal is actually moved. The bank sells you a contract that says you own 1 ounce of gold. But that gold is kept in a shared account where there's no specific bar with your name on it. You've only bought a share of a big pool. Now, here's an interesting question. If nobody ever asks for their actual gold, how many of these contracts can the bank sell? Here's the answer: as many as it wants. Because there's no law that says every contract has to be backed by a real gold bar. Industry estimates say that in the London market, for every 1 ounce of physical gold, there are more than 100 paper contracts. That means a ratio of 100 to 1. This means the price you see every day isn't the price of gold. It's the price of a huge pool of promises, of which only a tiny fraction is real. Now let's step out of theory and get back to reality. Central banks around the world bought 244 tons of gold just in the first 3 months of the year. It was the strongest quarter ever recorded, and the World Gold Council, which is the official body for this industry, has announced that a large portion of these purchases aren't even reported. In other words, central banks are secretly stockpiling real gold, and what are they selling to buy it? U.S. Treasury bonds. The same paper that's been the main pillar of global reserves for 50 years. When a country's central bank sells U.S. paper to buy metal and then hides that purchase, this is no longer just a rumor. This is a clear sign that even they don't believe the price on the screen is real. Now let's do a calculation that most people don't even think about. There's an index called the Big Mac Index. Economists use it to compare the real value of different countries' currencies. Like a hamburger that's pretty much the same product with a fixed price everywhere. Now let's try this logic with gold. In 1976, with 1 ounce of gold, you could buy 200 gallons of gasoline. Today, with that same ounce of gold, you can buy over 1,000 gallons of gasoline. That means gold's purchasing power against gasoline has increased 5-fold. So the problem isn't that gasoline has gotten more expensive. The problem is that the dollar has lost its value. And if the real price of gold is higher than the paper price we see now, this gap in purchasing power will get even bigger. For 50 years, they told us it was because of inflation, when in reality, paper money was losing value and gold stayed the same. Now, let's go back to China, because their plan is more precise than anything you can imagine. First, the Shanghai Gold Exchange. In this exchange, trading without physical delivery doesn't make sense. That means every contract is only settled when an actual gold bar is moved from one warehouse to another. This means you can't sell 10 contracts on a single gold bar because sooner or later that physical bar has to show up. Second, there's Hong Kong. Since foreign capital can't enter Shanghai directly, Hong Kong has become the gateway where the rest of the world trades at Shanghai's real prices. And third, which is the most important part of the story, Hong Kong is increasing its gold storage capacity from about 200 tons to over 2,000 tons. That's 10 times more. Now think about it, the paper market doesn't need any storage at all. When a country builds storage in advance for 2,000 tons of physical gold, it means they're sure that gold is actually going to arrive. Now let me make a prediction that goes beyond anything you've heard so far. This isn't just about gold, this is the beginning of a much bigger change. BRICS countries, that is China, Russia, and a few others, have been talking for years about a common currency for trade among themselves. Up until now, this currency hasn't had any backing. But when China sets up a physical gold market with real, transparent pricing, that's exactly what a new currency needs for backing. I think that within the next 3 to 5 years, at least a part of global energy trade will no longer be priced in dollars. It'll be priced in gold or in a currency backed by gold. If this happens, for the first time since 1971, the dollar will face real competition. To see if I'm right, check these two things. First, the gap between the paper price and the physical price of gold. The same thing that happened to silver in January, creating a 40% price difference. Second, central banks continuing to secretly buy gold instead of U.S. bonds. If these two things happen, it means we're basically witnessing a repeat of 1968 up close. The difference is, this time no one will be caught off guard because we've been warned in advance. What do you think? Do you think I'm right, or did I make a mistake somewhere in this analysis? Write it for me in the comments. If you found this video valuable, make sure to like it and subscribe to our channel. Most importantly, share it with someone you think needs to see this video.